Hey everyone, Aaron Filbeck here at Kai Association, Global Head of Content Strategy, and I'm joined by Hilary Wiek, who's a Senior Strategist at PitchBook. We're going to talk about private credit. There's a lot to talk about in this space, and it's certainly been an area of focus for us here at Kai as we think through thought leadership and content that we're putting out in the industry. And I'm excited to hear some expertise and views from Hilary. So, Hilary, thanks so much for joining the conversation.
Yeah, absolutely. Thanks for having me.
Well, so Hillary, one of the things that I've been noticing, and it's almost a contrarian indicator in some ways, is we go out and we talk at conferences and we see the topics that people are interested in. Private credit for the past, I don't know, 3 or 4 years has been one of the top topics that people want to really get into. And it's no surprise in some instances, the private credit complex has grown quite dramatically over the past 10, 15 years. And mostly driven by the direct lending growth that we've seen post GFC. But one of the things that I've noticed, and it's more anecdotal at this point, maybe not as much broad spread, is there's some questions around how sustainable is this growth. And we've also had a bit of a change in terms of environment as well. Interest rates have changed from what they were in the 2010s. We've seen some lightening of terms over the past couple of years and all sorts of stories around all of this. So I would just be curious from your perspective at PitchBook. You talk to a lot of different LPs, a lot of different GPs, just your general observations of what you've seen within the private credit complex so far.
Yeah, for sure. Just small bit of history for the listeners is that following the GFC, a lot of banks pulled out of direct lending, regulatory reasons as well as just regular risk practices. And so there was a void, and you've got folks like private equity where part of the value proposition is the L of the LBO, the leverage. And they were looking for something, and there were some happy to step in. I remember talking to Goldman right around that time, and I was more of an equity person, so I was trying to figure out even what this thing was. Flash forward a bunch of years, it's funny in our data because most of the data that I report on through, say, our fundraising report is private funds only, the drawdown funds. And our data wasn't really showing this massive ramp up in private credit. It showed growth, but it wasn't, a hockey stick. But that's because, and I know we'll get into this in a bit, but Evergreen funds have been stepping in here because it's an interesting match between, needing to provide liquidity and these loans paying liquidity. But yeah, originally this really was a supply and demand issue where the demand was stronger than the supply, where the private equity folks needed loans. But now, as you say, I think the supply might be way outpacing the demand, especially in a market where deal activity is way down. People find it really hard to conduct a deal if they can't put a price on something. And in order to put a price on something, you need to have some visibility into the future about what the trade efforts might look like, or a variety of other things. And so, deal activity just screeching to a halt means that there's not a lot of demand for loans. The demand is coming more on the other end of loans that, the original loan may have expected that the holding period would be a normal private equity fund type holding period, and these are extending. And so what we're hearing is a lot of the deal activity is refinancing, changing the terms of loans, things like that, which may not play to the strengths of a fund that is just hoping to go out and make direct loans that are fresh and clean and new.
So Hillary, you mentioned the fund structure element of this as well. So it's interesting to kind of look at the wealth growth in this space, and evergreens, semi-liquid funds, registered funds, whatever label you want to put on these different fund structures, have really been dominated, to your point, by income generating assets. So core real estate being one, private credit, mostly probably direct lending to a large degree, being another. It seems like in some ways that this is coming at the point when it's almost challenging for the industry to digest some of the flows that have been coming in. So again, you guys have written on this stuff quite a bit. You wrote a report on evergreen structures. We published some of that through our own channels as well. But maybe talk through that kind of evolution of fund structures that are more geared towards the individual investor, the high net worth investor, at a time, to your point, where it is becoming a little bit more challenging to assess the opportunity within private credit more specifically.
Yeah, another history lesson because I always have to start at the beginning. But if you go back is it now 40 to 40 some years when the 401k came into being, and more retirement assets are going into the control of individuals. Pensions are going away. Most of the people I work with will never see a pension in their lifetime. And so money isn't being funneled into big pools of assets that can make big contributions, have a diversified program, do vintage year diversification. They're going into individuals' hands, and a lot of individuals are lucky to have a few thousand, let alone the millions it would take to be making commitments to these. But and pensions at the same time are going away. They're freezing, they're de-risking, they're doing LDI, or some of them are closing up entirely. They're just saying, okay, insurance company, take this over. And so GPs are looking for capital to continue growing, especially the public GPs who Wall Street now is looking at them and saying, "Where's my growth going to come from?" Every year in and year out. So you're seeing them create more and more products, more and more structures to try to tap sources of funding that were not typical 5 to 10 years ago. And so the idea to go after the retail assets or private wealth assets are was absolutely, on the GP side, they're looking for that money. On the LP side, though, the private wealth folks to some extent might be operating under sort of a FOMO situation where they haven't had access to this before, and now suddenly they can. But they often have things that they want as part of a fund. They want maybe a little more liquidity. Individual people tend to be a little bit more nervous about locking themselves up for 10 or 12 years in a fund than institutions who, even if the CIO leaves, the institution still exists. And so, it should be able to continue funding these capital commitments and things. Um, so investing in a typical structure, even if they could meet the minimums, is tough for individuals. Um, so you've got demand on the LP side, you got demand on the GP side. GPs are creating structures, these evergreen semi-liquid structures, to try to handle some of these demands of the LPs with liquidity. And there's other things too that they're doing to structure these, but um, essentially they are creating structures that hopefully will satisfy the retail channel, and hopefully work for the GP too. But there's issues. One of the biggest ones is as these are very popular right now, if money comes flooding in, where's that money going to go? Everybody should be looking under the hood to say, wait, is this really private credit, or is it 50% in liquid investments, which don't have this supposed illiquidity premium? And you may not be getting what you think you're getting, because for the interval funds, for those who are unaware, the typical structure, and there are a lot of varieties, but the typical structure is every quarter the GP says in the documents that they will offer 5% of the total capital of the fund in liquidity if people want to pull out. It's not that my investment, I can only get 5% of it back unless every single investor is also asking for money back. But in a typical market environment where monies are flowing in and out and income is being produced from these real estate or private credit assets, there should be enough to fund any redemptions that people want. Um, there are issues where, what if things aren't normal conditions? What if everybody wants their money out at the same time? A lot of us have concerns about that. The documents say that they can gate it. They can say, well, we're going to allow the 5%, or in some cases they have the capability of saying, no, we're not giving anything back. This is a really bad time to be making this fund less liquid or to try to sell assets to fund redemptions. We're going to lean on the semi-liquid aspect of this investment. Um, I feel like I just said a lot, but I'm not sure I said everything I meant to say. So,
No, no, no,
um,
no.
yeah.
I think the other thing, and you mentioned this as well, like, so there's a lot of concern about the liquidity lever of actually getting your money back. But then there's also the question of actually investing. Like, what is the fund actually investing in at the end of the day? And to your point, it could be liquid assets, and you're not getting true private credit. On the other hand, if it is true private credit, you've got to put that money to work. So what does that mean for actually, um, if you're making loans, you've got to make loans quickly in order to be fully invested. So I don't know if you've given thought to that as well in terms of if you're going fully illiquid in an evergreen format, what does that look like? But I'm just curious on that.
Well, I'd say nobody is going fully illiquid in an evergreen format. You got to have some sort of liquidity buffer. There are two types of these funds. The interval fund is an actual structure as governed by the SEC, like it's actually named on the SEC website. And that one makes a lot of sense for LPs. They can ask for money back, but it's not a great fit for, say, private equity, where you buy a whole company. You can't just sell some shares to let somebody out. You have to sell a whole company, and that may not be the right time to do that. And so there are what are called tender offer funds, where it's more in the hands of the GP to say, typically we will try to provide liquidity, but we will offer it at moments like maybe we have just sold a company because it was the right time to sell that company. We'll reach out to the investors and say, would you like this capital back or would you like to roll it? And so that makes a lot more sense for equity structures, at least on the interval fund side. If you've got private credit or you've got real estate, you've got the opportunity to kick off income. But again, in bad times, some of these private credit loans may turn into PIK loans, and there isn't liquidity. There's just more debt being piled on. The other thing to think about is, are they making loans that are direct, like, okay, we're borrowing money, have your money? Or are they doing revolvers? Are they doing something where it's up to the borrower to decide if they're going to take that capital or not? And so that requires a whole nother liquidity equation. So we're seeing sleeves in most of these funds that are more liquid than what you would get if you were doing a straight drawdown fund where the GP didn't have to worry about monies flowing in and out. And some of them, there's the private credit ETF, I think, and I haven't looked deeply into it, but my understanding is it's like they're calling it an ETF, they're calling it private credit, but it's like 15%, which is the SEC rule around liquidity for funds that trade like that. So definitely people should be looking under the hood to see exactly what they're getting.
Yeah. So Hillary, maybe put on your old LP hat on and thinking about due diligence on these questions. And again, I'd love for you to kind of tie the fund structure element of this, given this is where a lot of the momentum has been for private credit, with private credit itself, and things that LPs, investors should be looking for, questions they should be asking, considerations at the end of the day as they start to allocate to private credit in 2025 and beyond.
There's so many of these questions. I sketched out a list. I think it was at least 14 or 15 long, but I'll try to hit some high points. First one's going to be fees. How are they charged? What are being charged? You might look and see, oh, a management fee is 1.5%. That's great. But what else are you being charged? Especially the smaller the amount of capital you're putting in, you're put in different share classes that pay different amounts. So just because you can have access to these funds doesn't necessarily mean you should do it. So absolutely be looking at those. On the other side of fees are the incentive fees. Some of these evergreen structures are allowed to do incentive fees, I think only if they have qualified purchasers, though there's some exceptions to that as well. Um, and if they're doing incentive fees, my understanding, and again, I haven't done a deep dive into the weeds of some of these terms, is that they are taking these incentive fees on an annual basis. And they are taking incentive fees on illiquid investments. At least in a drawdown fund, they didn't take their incentive until they sold a company. There is a market price on that asset. But if they're taking incentive fee on an illiquid investment on a valuation that the GP itself came up with, we've got a serious conflict of interest here. So, if you are, if listeners are also institutional investors considering these funds, which there's some good reasons for that as well, they really need to be thinking about and talking to these GPs about their valuation policies. Even if valuations are audited, it was ridiculously late in my career that I realized that um, auditing a fund doesn't mean that they're saying this is a good valuation. It's saying they followed the process. And so the process might be, hey, go look for the most, the company out there with the highest multiple, and we're going to value our company based on that. And the auditor can say, great, that's you followed the process, and the LPs are just at the mercy of whatever the GP came up with. So, the one thing that is really positive of the drawdown structure is at least they can't take their incentives until there's somebody else has actually said, we are going to pay you this much for this company. Um, So yeah, so we talked a little bit already about liquidity provisions, find out what they are, how they're going to handle liquidity in different scenarios. A lot of them right now are probably saying, "Hey, money's pouring in, it'll be easy to meet liquidity," or income's coming off and we're, charging 8%, so paying a 5% every quarter shouldn't be a problem. But what are they planning to do in a downturn? What are they going to do if there's a run on the bank? And we saw it a few years ago in some real estate funds, and they did gate. I expected it actually to be a bigger scandal and cause more of the private wealth channel to say, "Oh wait, what's going on here?" But it turned out it seemed like it wasn't a lot of American investors that were pulling out, and so they didn't feel the pinch like the folks that were trying to get out did. Conflicts of interest. If these fund managers are managing different fund structures, where are they getting their money from? Are they no longer incentivized in their drawdown funds? So I'm worried, even if I was committing only to drawdown funds, if my fund manager is branching out into other strategies, because the drawdown funds, 2 and 20, that 20% may not be buying their Ferraris anymore. It might be coming from a lot of steady income coming off of these evergreen funds, and I want to make sure that they're aligned with my interests. So trying to work your way through what all these conflicts are on that side. But then there's the conflicts of what if I buy the same asset? And no, I am talking more private equity. If I'm buying the same asset in a drawdown fund and an evergreen fund, maybe it's a tender offer fund, when do you sell it? Do you sell it when you're at an artificial end of life of a drawdown fund, or do you sell it when the evergreen fund might see it's the best time? And who do you think of? A lot of people think of the front end. Okay, great. I asked the question about conflicts. They take this asset and they put however much is deserved in the evergreen fund based on its size versus how much should go into the other fund. Cool, they handled the conflicts, but I'm worried about the exit. I'm worried about who they're going to listen to. Who are they going to sell it at the right moment, which may not be the right moment for the drawdown fund, or are they going to sell it, at some artificial time because it's the time to sell it? Um, what else could we talk about? Oh, well, okay, so one is most of these private credit funds, because they got started sometime post GFC. Some of them have that full history, 15 years or so, but a lot of them don't. Most of those people have not managed through a crisis. So, do they know about private credit in a bad time? Do they know about private credit when, liquidity dries up, when things are getting distressed? Are they the kind of fund manager that's going to work alongside the private equity company? Or do they have enough scale and enough capabilities to take over the company if needed, depending on what level of debt they have. So you really need to probe into that if they're talking about if they're in a fund structure and the firm itself is new enough that they've actually never had to go through it. Hypotheticals are great, but it'd be great if you could find people with the experience who actually have done this and had to work their way through it. Um, what's the fund planning to target for its investments? That's gonna, it goes back to that liquid versus illiquid, but also what I was talking about earlier. If you do a revolver, that's going to be a very different fund profile. Are they going into floating rate, or are they going to fixed rate? These are general private credit questions, but it's just as important on the evergreen side to be aware that or try to find out what they're doing. Most GPs will have a investment policy that you could drive a truck through. So if you can try to nail them down to try to have a little bit more certainty about what you're investing in, that could be a good idea. So I could go on and on. And I have. So why don't we focus in on either another topic or maybe something that I've already said?
No, no, I think all that's great. Hillary, in terms of maybe final question for you in terms of private credit, I mean, anything else that you think investors should be looking out for, or anything you guys are paying attention to at PitchBook in terms of areas of research within this space, just given how fast it's growing and the level of interest that's been there?
Yeah, so our parent company is Morningstar, and the two of us are both working on what we're calling this public-private convergence. Morningstar is rolling out interval fund ratings, and we've been in contact with them and helping advise how they're going to do that because they're talking to fund managers they typically haven't talked to before. KKR was not in their normal call list. And so those will be rolling out. The first ratings will come out in the third quarter. We are putting out more research, and we're most important getting data piped into our platform on all these fund structures. So we're getting a lot of questions right now about market size and about performance and about fund flows, and we will be able to answer those. We're not quite there yet. So as you say, we put out a report last fall called the Evergreen Evolution. That was very manually put together. One of my colleagues put a lot of time and effort trying to find every fund and then go to their tear sheets and pull all this information together. We're going to have that live, hopefully by the end of the year. Um, I feel like there was one other thing I was going to mention. Oh, on the due diligence side, I would also mention that I put out a piece a couple years ago that was called an LP's Guide to Manager Selection. And that walks through a 6P framework, because it's always got to be a P framework if you're going to have a framework. But it talks about the people, which includes the firm and the team. It talks about the philosophy and the process. Those are all six of those Ps I put in there with a lot of sub ideas of what to think about. So if anybody's trying to figure out how to diligence these, that framework really should work for any fund manager or any fund type that you're looking at, to hopefully give your idea, give your qualitative assessment, particularly, maybe round it out a little bit. So, and I plan to sort of rewrite that hopefully this year if I find the time, with an evergreen perspective in mind, in terms of asking about these conflicts of interest, asking about liquidity, and come up with some more questions that are targeted towards the specific area.
Well, we certainly look forward to seeing the update. I remember when you published it; it was a great piece, and we're also certainly aligned on that convergence. That's it's a continuing to be a trend that's disrupting our industry and exciting, but also challenging, I think, for a lot of investors. So, Hilary, thank you so much for sharing your thoughts and insights. Always a pleasure, and thanks for all you do for Kaya. Looking forward to continuing the conversation some other time.
Yeah, absolutely. Thanks for having me.